Let's dig in deeper on today's action with Paul Hickey, the co-founder of Bespoke Investment Group, and Mona Mahajan, senior investment strategist at Edward Jones. It's good to see you both. Mona, I'd love to start with you here. I mean, clearly the market got a little more of a hawkish message from Jay Powell than it was positioned for, although not necessarily a brand new one, not necessarily something we might not have expected given how strong the economic data have been, and I guess what other Fed officials have been discussing. Where does that leave you with regard to whether today's move was the start of something on the downside?
Yeah, it was interesting. Jerome Powell reiterated the messages that we've been hearing all along, as you noted, which is rates could go higher. They could stay higher for longer. But what was interesting from a market perspective, we saw two moves that caught our attention. The first was the probability of a 50 basis point rate hike. So, the Fed had been considering downshifting to this 0.25% or 25 basis point rate hikes at the next March meeting. Now markets are forecasting with a 70% probability, a chance of a 50 basis point rate hike. That was up from just 30% probability this morning. So that was one notable move. The second one, as you highlighted earlier, was this move in the yield curve. The 2-year yield moved pretty dramatically higher. It was at over 5% today. That's the highest of the year and the highest really since 2007. But meanwhile, that 10-year, which is a better predictor of maybe long-term growth, that didn't move that much. So what that did was invert the yield curve even further and perhaps signal that markets are expecting a bit of an economic downturn ahead. Now, what we would say is this was just one day, and we still have a lot of important March data ahead. Of course, this Friday, we get the jobs report. Next week, we get inflation and retail sales. And then, of course, on March 22nd is the Fed meeting. So all of those could shift the narrative once more. And what we think is if we start to see inflation cool, especially if wage growth cools, that could once again shift the narrative to a Fed that will downshift and will eventually pause in mid-year. So that still remains our base case. But today did jolt the markets a little bit with the surprise, especially on the 50.
Paul, investors on some level have been hoping for a data-dependent Federal Reserve. In other words, one that wasn't just lifting rates higher in a really aggressive way to catch up to inflation. We seem to have that now. How did you think the market absorbed it all? We've been dealing since early February with aggressive moves higher in bond yields, and stocks did pull back, but did sort of also find some traction last week.
Yeah, so I think today was a big overreaction on the part of the market. What have Fed officials, like you said, been telling us for the last 6 weeks? That rates are going to be higher for longer and that we may have to hike rates to a higher level. And the market has been pricing that in for the last month now. And then today, Powell basically says that exact same thing. And so the market freaks out. So I think in that respect, it's a little bit of an overreaction. We still have a lot of economic data to go over the next couple of weeks. And just look at how quickly these narrative has shifted over the last 3 months. You saw in December and early January, we were going into a deep recession that everyone thought. Now the economy's overheating and inflation is low. I mean, and all it took was, a warm January, some seasonal adjustments causing stronger than expected data. Well, guess what? February saw gas prices, which were up 9% in January, fall over 4% in February, which was the second worst February going back to 2004. So I think that can act as a headwind on inflation. In other words, pushing it lower. So I think, it's observation is a dying art, as Stanley Kubrick once said. But there's no perspective on the market, and the observation's dead because nobody is taking into account what the market has been telling us for the last 5 weeks and what we've been pricing in. So I think, again, as I said earlier, it's a bit of an overreaction today.
Although, Mona, I guess the longer the Fed is in hiking mode, and if they maybe take a larger step, and if they, feel the need to take that final destination rate even higher than expected, it leaves more time and more room, perhaps, for the economy to have that downturn that you said the yield curve is anticipating. I mean, I suppose that's what the market's worried about. Yet it's coming in the context of we're worried about the actual jobs market being too strong and consumers have been spending too much money. So there's a little bit of a dissonance there.
Yeah, it's a bit of a tug of war between the better data we got in January versus what the Fed is doing and what the lag impact of that may be to the real economy. What we'd say is we wouldn't necessarily extrapolate this strong January jobs report at a pace of 500,000 plus jobs added, a 3.4% unemployment rate, not necessarily extrapolate that to the rest of the year. In fact, we would expect some softening in the months ahead, driven not only by higher rates, but just a natural cooling in consumption, as well as margin pressure on corporations. All of these have yet to take meaningful impact in the months ahead. So we would still anticipate a slowdown. Now, by no means do we see any sort of deeper prolonged recession on the horizon. But keep in mind, we would expect a period of economic softening, but we also expect if the market can meet a few conditions, we probably are set up nicely for a better back half return perspective as we head towards the end of 2023. And these conditions are basically inflation moving more meaningfully lower, the Fed moving to the sidelines at some point, and of course, earnings. They've started to show signs of real troughing, but we need to see a complete bottoming process there as well. But we do think we'll be set up nicely if those conditions are in place in the months ahead.